Manish Chaudhary, good morning. Thank you for joining us. The big story is Tata Motors.
Absolutely. So, what do you want me to say about that?
What's the way forward for the stock now? Good time to buy, or the story is over for next 2 quarters?
So, actually last night, since the profit warning came in, we downgraded Tata Motors to hold. We were earlier positive on, in particular the volume upside that the company was seeing. But now it's clear that that kind of volume growth has come at the cost of margins. And recall what happened, about I think 3 quarters back when a similar margin disappointment came on the JLR numbers. And, the stock actually declined about 20% over the next 2 to 3 days. So we think that even though in the morning trade the stock is down about 9 to 10%, institutional investors should possibly book profits even now. Our 1-year forward price target is at 285 on Tata Motors after the downgrade that we did last night. And, so that would imply that right time to enter the stock from a 1-year perspective is possibly somewhere close to 250. So, we think that at least in the foreseeable time horizon, the stock would remain weak. And, even after this 10% downside in the morning trade, it's not yet overdue in terms of booking profits in the stock.
Do you think the stock could come down to 250? Because what else could go wrong for Tata Motors? The profit booking is out there. What else could go wrong now?
Well, I think, this most recent guidance in terms of margins, that would gradually get factored into earnings estimates of, the brokers and investors across the street. And we think that consequently the earnings estimate downside could be somewhere in the range of 15 to 20%. So that itself is enough to pull the stock down by somewhere close to somewhere in that range, about 15 to 17%. And I think, over the next few trading sessions, those expectations could get factored into the stock price.
The potential of gas prices going up, Manishi, how are you positioning yourself in the exploration stocks?
Well, we actually are quite positive on the regulated oil and gas space. In our model portfolio, we have both BPCL and ONGC. If you look at this entire space, oil and gas, you would see a gradual trend towards deregulation, a gradual trend towards decline in consumer subsidies that the government is putting through and the oil companies have been going through over the last few years. That is obviously a big positive both for the E&P side and for the oil marketing companies. So we remain positive on that space. In fact, you would recall that in December, actually, we upgraded ONGC to a buy from a hold. And we have been reiterating buy on BPCL over last, at least 3 or 4 weeks. So we clearly stick to that stance, and this cabinet request on gas price increases, that has clearly come as an additional shot in the arm for ONGC. And, so I think in the medium term, there's no reason to change our positive stance on the regulated oil and gas space.
Manishi, if I map the environment and the news flow along with the global liquidity, things have been quite constructive. But if I look at benchmark indices, the market breadth, small and the mid-cap, indices, the energy levels are low. Energy levels are tepid. Momentum is missing.
No, that is true. I mean, see, India has outperformed the global and regional indices over the last 1 or 2 quarters, particularly since the government's announcements about structural reform started coming through around mid-September. And I think the market has moved up significantly on expectations. It's not that earnings estimates have moved up significantly. This particular result season started well with the IT companies and with the private banks. But now we have had, and also some of the other large companies like Reliance as well, but now we've had disappointments from the likes of Hero MotoCorp, from Tata Motors, possibly from some of the other industrial companies also. And, we still don't have a sense of how the public sector banks are going to pan out over the next couple of weeks. So I think that initial euphoria about the earnings season is kind of getting, I would say it's kind of petering out. And that is the effect that you're seeing in the markets also. In the near term, therefore, I think it would be prudent to expect some correction in the market. It may not be a very deep correction, though. Maybe 5 to 7% from here, because there's still significant money waiting in the sidelines to be invested. But if the market does correct about 5, 6, 7%, and consequently the high beta stocks correct a little more, then I think that would be the right time to take an exposure to the frontline stocks in the Indian market once again.
Right. From the broader market, some of the media names, the likes of the Sun TV, Z Entertainment, distribution a name like Dish TV. How would you approach that segment of growth?
Yeah. See, on a bottom-up basis, we do like the media space. In fact, we have consistently had a buy on both Sun and Z, the names that you mentioned. They have done phenomenally well. And I think, investors may be tempted to book some profits in the near term, even though for investors having a longer term perspective, maybe over next 12 to 18 months, we think that these stocks still make sense, partly because, the advertising revenues are likely to grow. These two companies in particular are seeing decent traction in their rating points, and therefore it is, likely that their advertising revenues would possibly remain stable or would possibly even increase going forward. And there are other opportunities in the space which are specific plays on regulatory changes like Dish TV. I understand the results from Dish TV have been nothing to write home about, but we are quite positive on this regulatory changes that have been coming through. So net, to cut a long story short, we are quite positive on the media space and particularly the market leaders in each of the individual segments.
But Manishi, your house view is that HDFC Bank is a good bank to own, but State Bank of India is where the real value is. Do you think this year, don't buy HDFC Bank? I asked you this question last time. I again will revisit that question.
Right. And the tug of war between these two, in a sense, they're polar opposites. HDFC Bank is possibly the safest bank in India, and on a routine basis, they would declare about 20 to 25% earnings growth, very low NPLs, almost no concern on the non-performing loans, and as a consequence, the expensive valuation that HDFC Bank trades at tends to remain expensive. So, if we are concerned about the market in the near term, maybe over next 1 quarter or so, then possibly the best bank to own is HDFC Bank, because among the banking space, it's one of the best defensives. On the other hand, State Bank of India is a classic high beta, and if one takes the point of view that interest rates are going to decline on a sustainable basis, then the public sector bank space in general is likely to do well, because that space is looked upon as a bond proxy. Because they are the biggest owners of the government bonds. So this is the kind of tug of war that an investor may face. One critical element or one important news flow to look at would be on Jan 29th, not just in terms of what the Reserve Bank of India does on that day, but also what it says, and the kind of body language that comes out from the governor. We think that after this significant rally in the public sector banking space, they have moved up about 30 to 40%. It is perhaps prudent to position oneself slightly defensively in the Indian banking space. And perhaps it's better to take a call, and if one is tempted to buy into the public sector banking space, to look at those which haven't really moved that much. And one example to that effect could actually be Punjab National Bank, which has actually underperformed the public sector banking space, but the characteristics of that bank are pretty similar. So that is really how we are approaching the banking space in India. We clearly have much larger weight on the private sector banks, including ICICI, Axis, HDFC and HDFC Bank in that order. And we also have some of the NBFCs like Power Finance Corporation and LIC Housing Finance. As of now, we don't have any of the PSU banks. And as I said, that in the PSU banking space, it's perhaps better to focus on the ones which have not really moved up so much as their compatriots.
Right. Give us, before we let you go, Manishi, give us a quick call on real estate and how do you approach there? Of course, this, HDIL continues to battle concerns of promoter hedging, but what's the call there?
Yeah, real estate it's kind of a difficult space to play in India. So let's take Asian markets in general. I mean, on the Asian markets overall, we're actually quite positive on the property space. And we have pretty significantly large weights in Hong Kong property and China property. But when it comes to India, because of stock-specific reasons, it becomes a very difficult space to play. Because the larger frontline companies either have management-related or disclosure-related issues attached to them. You talked about HDIL, where the promoter has pledged almost his entire shareholding, which is obviously a big concern. And, for some of the other large companies like DLF, there is, there's a clear issue about leverage that the company still has on its balance sheet, and somehow it's been unable to reduce that leverage significantly over the last few quarters. So we think that in the Indian property space, one should focus on those companies which are secular cash generators. And I would highlight 2 or 3 companies which fit the bill. They are Oberoi, Shobha, and Prestige. Out of these, we have Oberoi in our model portfolio, and we have, just about a neutralish stance in the India model portfolio as far as property is concerned. And, we think that there are significant catalysts for Oberoi in terms of new property launches that are coming through. But it's really that space which have better corporate governance, corporate disclosure, and most importantly, cash generation that I think one should look forward to.